A retiree withdraws $80,000 from a retirement account. The money lands in a checking account, the bills get paid, life continues as usual, and nothing about the transaction appears unusual. There is no warning message from the bank, no notification from the government, no indication that anything significant has happened. Months later, however, that same retiree discovers a larger tax bill than expected. Medicare premiums increase. A greater portion of Social Security benefits becomes taxable. Suddenly, a decision that felt routine turns out to have consequences that extend far beyond the original withdrawal. This is one of the most misunderstood realities of modern retirement. Despite what many alarming headlines suggest, the issue is not that the IRS has imposed a secret checking account limit. No such universal limit exists. Yet the reason these stories attract so much attention is that they tap into a concern shared by millions of retirees. The feeling that ordinary financial decisions can produce costly consequences that are difficult to see until it is too late. The truth is more nuanced than the headlines, but it is also more important. The real challenge facing many retirees is not how much money they have. It is how the financial system interprets the movement of that money. For most of their working lives, people focus on one objective above all others: building wealth. They contribute to retirement accounts, purchase investments, increase savings, and attempt to grow their net worth year after year. Financial success is often measured by accumulation. The larger the portfolio becomes, the closer a person appears to be to financial security. Retirement introduces a fundamentally different problem. Once the accumulation phase ends, the focus shifts toward distribution. Money that spent decades growing inside retirement accounts must now be converted into income. While this transition sounds straightforward, it introduces a layer of complexity that many people never fully anticipate. The reason is that retirement income does not exist in isolation. Every withdrawal, distribution, and income source becomes part of a larger network of calculations that influence taxes, healthcare costs, and benefit eligibility. This network is largely invisible to the average retiree. Most people see bank balances. The system sees income classifications. Most people see transfers. The system sees taxable events. Most people see money moving between accounts. The system sees data points that feed into a variety of formulas. That difference in perspective explains why retirees are often surprised by financial outcomes that seem disconnected from the decisions that created them. Consider how most people think about a checking account. It is typically viewed as a storage container for money. Deposits arrive, expenses leave, and the balance changes over time. The account itself appears simple because its function is simple. What many retirees fail to recognize is that the checking account is usually the final stop in a much longer financial journey. Before money reaches that account, it may have passed through retirement plans, investment portfolios, pension systems, Social Security program, or taxable investment accounts. Each of these sources follows its own set of rules, and those rules often interact with one another in ways that are not immediately obvious. A retiree who withdraws funds from a traditional IRA may believe they are simply accessing savings. In practical terms, that is exactly what they are doing. However, tax authorities may classify the withdrawal as income. Once income enters the equation, a series of additional calculations can begin. This is where many retirees unknowingly encounter what could be described as invisible thresholds. Modern retirement planning is filled with income-based thresholds that determine how various benefits and costs are calculated. These thresholds are rarely discussed in everyday conversation, yet they can have a significant impact on financial outcomes. Crossing one threshold may cause a larger percentage of Social Security benefits to become taxable. Crossing another may result in higher Medicare premiums. Crossing yet another may affect eligibility for certain programs or deductions. The important point is that these thresholds often operate gradually and quietly. There is rarely a dramatic event that signals their existence. A retiree does not receive a phone call informing them that they have entered a more expensive category. Instead, the consequences typically appear later, often separated from the original decision by months or even years. This delay creates a powerful psychological challenge. Human beings are naturally good at recognizing immediate cause and effect. If someone touches a hot stove, the consequence is immediate and obvious. Financial systems rarely work that way. the consequences are often delayed, indirect, and hidden beneath layers of calculations. As a result, retirees frequently underestimate the impact of decisions that seem harmless in the moment. Research in behavioral finance has repeatedly shown that people tend to focus on visible outcomes while overlooking secondary effects. In retirement, these secondary effects can become surprisingly expensive. A withdrawal generates cash today. That is the visible outcome. The same withdrawal may increase taxes, alter benefit calculations, or raise future healthcare costs. Those are secondary outcomes. Because secondary outcomes are harder to see, they often receive less attention, despite having a substantial impact on long-term financial security. This helps explain why two retirees with remarkably similar financial resources can experience very different results. Imagine two individuals entering retirement with comparable savings, similar lifestyles, and nearly identical spending needs. On paper, their situations appear almost indistinguishable. Yet over the next decade, one consistently keeps more of their money. The difference is not necessarily investment performance. It is often the result of how retirement income is structured. One retiree may draw income from multiple account types, maintaining flexibility over taxable income levels. The other may rely heavily on tax-deferred accounts, unintentionally creating larger taxable distributions over time. The contrast illustrates a broader principle that is often overlooked. Retirement is not simply about accumulating assets. It is about managing the interaction between assets and financial rules. This distinction becomes increasingly important as retirees age. Required minimum distributions provide a useful example. These mandatory withdrawals were designed to ensure that tax-deferred retirement accounts eventually generate taxable income. While the concept itself is straightforward, the consequences can be significant. A retiree who delays withdrawals for many years may eventually face larger mandatory distributions. Those larger distributions can increase reported income, which in turn can affect taxes, Medicare costs, and other financial considerations. What initially appeared to be a strategy for preserving wealth may create a different challenge later. This does not mean delaying withdrawals is always a mistake. In many situations, it can be beneficial. The important lesson is that every financial strategy involves trade-offs, and those trade-offs often extend beyond the immediate objective. Unfortunately, many retirement discussions focus almost exclusively on investment returns, while paying far less attention to distribution strategy. Investment returns matter enormously, but they represent only one side of the equation. The other side involves efficiency. How efficiently can accumulated wealth be converted into usable income? How much is lost to taxes? How much is lost to healthcare-related costs? How much flexibility exists when circumstances change? These questions often determine retirement outcomes just as much as portfolio performance. In many ways, retirement planning resembles navigating a complex system rather than solving a simple math problem. The objective is not merely to maximize wealth, it is to understand how different components interact. Tax laws interact with retirement accounts. Retirement accounts interact with income levels. Income levels interact with Medicare calculations. Medicare calculations interact with spending power. Each connection creates consequences that may not be visible from any single account statement. This is why the discussion surrounding checking account limits ultimately misses the larger issue. The checking account is not where the real story begins. It is where the story becomes visible. By the time money reaches a checking account, many of the most important financial decisions have already been made. The source of the money, the type of account it came from, the timing of the withdrawal, and the way it is reported all play a role in determining the final outcome. The retirees who navigate this environment most successfully are often not the ones with the largest balances. More often, they are the ones who understand how financial systems interact beneath the surface. They recognize that money does not simply move through accounts. It moves through a network of rules, incentives, and calculations that shape what ultimately remains available to spend. The central question, therefore, is not whether the IRS has created a checking account limit. The more meaningful question is whether retirees understand the hidden mechanisms that influence how much of their retirement income they actually keep. Because in today's retirement landscape, financial success is determined not only by how much wealth is accumulated, but by how effectively that wealth is managed once it begins to flow. And that difference can quietly amount to thousands of dollars over the course of retirement.